The Institute of World Affairs at the University of Wisconsin-Milwaukee presents International Focus, a weekly discussion of the people and events behind today's global headlines. Support provided by Milwaukee Public Television and the UWM Center for International Education. Now here's your host, Doug Savage.
Welcome to International Focus. Our topic today, Euro Meltdown. With Greece teetering on the brink of default and other EU members positioned as the next economic dominoes to fall, governments and businesses throughout the 17-nation Eurozone are making contingency plans for the collapse of the euro. Though the economic aftershocks of such a seismic event would be dire, the prospect of continued underwriting of the EU's weakest economies is becoming politically problematic in the Eurozone's more creditworthy nations. Meanwhile, across the ocean, U.S. Treasury Secretary Tim Geithner warned in recent congressional testimony that the European crisis could undermine U.S. growth if it's allowed to spread. To help us explore the roots of a potential euro meltdown and its implications for economies on both sides of the Atlantic, we're joined by Abdur Chowdhury, Chairman of the Department of Economics at Marquette University. Dr. Chowdhury has also held several senior posts outside of academia, including a stint as Chief Economist of the United Nations Economic Commission in Europe. And Ken Spirewka, Vice President of Foreign Exchange Trading at U.S. Bank. A foreign exchange practitioner for nearly 2 decades, his current position focuses on currency risk management and mitigation. Gentlemen, welcome to International Focus.
Thank you.
Well, Abdur, maybe you could start us out by just giving us a picture of how we got here, sort of a sovereign debt 101, if you would.
Sure. Basically, this debt problem that we see here today in Europe has been in the making for a number of years. What happened was, within the Eurozone, a number of countries, Greece, Portugal, you can think of Italy, for example, they had been borrowing more than they should have. If you look at the European Union, they have a debt-GDP ratio of 60% as sort of the target. But many of these countries have exceeded 100% ratio.
We've got a slide here with just, for those of you who don't recall the 17, there they are.
Yeah. So they have a debt-GDP ratio more than, Greece, for example, has more than 140% right now. So what is happening is, now that some of these debts are coming to mature, these countries simply don't have the money to pay for that. Okay, so it's a problem. They might default. So the European Union has, the Eurozone and the European Union, they have come up with this, what we call the EFSF, the European Financial Stability Facility, where they have a certain amount of money that they would like to use to basically bail out these countries. Now the question is whether they can bail out these countries depends on at least 2 things right now. What will happen in Slovakia, for example, the voting that they're supposed to have in the parliament, and also what happens in Greece, whether the Greek government was supposed to meet some austerity conditions imposed by IMF, the European Union, and the European Central Bank. Next week we'll be able to find out a little bit more about that. So if that doesn't go through, then I do see some serious problem in the future.
And Ken, when nations faced this situation in the past, there was sort of a traditional fix where, if need be, you would default on your loan, you devalue your currency, making your goods and services cheaper, and you could sort of export your way back to prosperity. That's not an option here.
No, it's not an option because of the structure of the euro, of course, and they don't have one particular monetary policy that's can be insular to a particular nation. So in order to arrive at a synthesized policy is a very difficult task. So unlike the U.S., where we can metaphorically print money, as we've been accused of doing to bail our own economy out, they have a much bigger task at hand as a result of the way the euro is structured. So as Dr. Chowdhury alluded to with respect to the way that they're going to go about that in terms of devaluation or anything like that, in terms of trying to resurrect a particular part of the Eurozone becomes a very paramount task. Greece can't unilaterally pull itself out of the euro, and they don't have any mechanism by which to weaken their portion of the euro. So the likelihood of them trying to default or get out of the euro becomes a very paramount task for the entire region.
Well, let's take a look at another slide here. On its own, Greece represents about 2% of the GDP of the Eurozone. Two other countries have already received bailouts, Portugal and excuse me. So the total of the countries that have received bailouts are just 7%. But there are two other economies who have just been downgraded, and being Italy and Spain, much bigger economies. So you see the total there, the total at-risk portion of the Eurozone right now is over a third. So is that really the significance of Greece at this point, rather than just Greece for its own sake, Greece as the potential underminer of confidence in the market as a whole?
Actually, the problem here is not the size of Greece, but the fact that the money that the Greece borrowed were from banks from a number of countries, most importantly from Germany and France. So, for example, if there's a disorderly default in Greece, that would significantly affect the French and the German and also the Belgian financial system.
Well, it's the old saying of, if I owe the bank a little money and I can't pay, I'm in trouble. If I owe the bank a lot of money and I can't pay, the bank's in trouble.
Is in trouble. Exactly. That's basically what is happening in Europe. So if you ask me what's the way out of this problem at this point, I believe that the only way out at this point is an orderly default of Greece within the Eurozone. Because if Greece, as we heard, that there is no mechanism for Greece to leave the Eurozone at this point. So let them stay within the Eurozone, but let's have a orderly default where the banks will take a haircut, but the lenders basically will take a haircut. And I think that's where the Eurozone countries are moving at this point.
And what is the role of just perception in all of this? You know, we see almost on a daily level, you know, the markets are happy with something that has been done by the European Central Bank and other policymakers, or then they're not as happy and the markets take a tumble. How much is actually based on sort of empirical policy and how much is just perceptual?
Well, it goes by the old adage, you buy the rumor, you sell the fact type of situation. Mm-hmm. And the problem that we have in the markets today is really the technology and the speed at which an investor, an institution, a hedge fund has access to information. It never used to, you used to have to wait on a more fundamental basis to make an investment decision. Now they're made second by second, and they're made on little blurbs, sound bites that they hear from the media, that they see on the internet, that they see on CNBC. And so, as a result of that, the market has become a much more volatile place, which provides opportunity for speculators in the marketplace. But if you look at how the activity in the market takes place, it's still relatively orderly on balance. When you look at the ranges and the actual trend of a particular currency's direction, the euro remained, in light of all this, extremely resilient currency. Hanging around in the upper 130s and the 140s for a long time, much after this problem with Greece emerged, along with the contagion potential and the other larger scale economies in the EZ. So, I guess perception. Back to your point, perception plays a large role in it. I think, and I think fundamental trading has sort of taken a back seat to more of the flavor of the second or the flavor of the hour, and but the trends remain largely intact. And now we're seeing that the euro is finally starting to show some chinks in its armor, and has lost more than 10% of its value very precipitously. And that trend will probably continue as we see flight to quality, meaning investors going into the U.S. Treasury market as well as the Japanese Treasury markets to basic capital preservation plays.
Well, and let's talk a little bit about that. One of the spill-off effects of this is that flight of capital. To a non-specialist viewer, isn't that a good thing if more money is coming into the U.S. system?
I would say that in the long run, it's not a good thing for the U.S. at this point. The reason is this flight of capital to the U.S. to a safe haven is increasing the value of dollar. And if you look at the U.S. economy over the last 2 years, post-recession period, what has been driving our recovery, whatever recovery we have, is a net export, which was due to sort of a weak dollar that we had. Now, if dollar becomes stronger, that will hurt our net export, and that will affect our recovery going forward. So that's one of the, I think, impact of the European crisis that may have an adverse effect on the U.S. economy, in my opinion, the stronger dollar, because of this flight to safe haven that we're talking about.
Well, we've got just a little over a minute before our break, but you know, the euro has been with us now for just under a decade. A lot of business models have been predicated on that common currency. What would be some of the effects for businesses on both sides of the ocean were there to be an unraveling, as unlikely as that may be?
Well, first of all, the unlikeliness of it is the jury's still out on that. You can find arguments on both sides that it makes sense. If the euro were to unravel, I think what we'd see is fractions of a different unified currency, maybe led by the French, perhaps, and Germany go on its own.
Sort of a mini euro.
A mini euro, if you will. And it's tough to determine what sort of impact. The first impact is always going to be knee-jerk negative. You know, so if the euro were to get unwound, or if there's any sort of imminent probability that that's going to take place, I think that would be very negative initially for the euro. I think over the long haul, it would be positive for the region, simply because the euro, from just a theoretical standpoint, doesn't make sense. Just because you don't have cohesion politically, you don't have cohesion in economic policy, and the cultures are very diversified and different. And so to sort of try to put all these people together to synthesize one common thread is a very difficult task. So I think the breakup of it ultimately, if it were to fall in that way, would be a net positive in the long term.
Well, we're going to take a short break, but when we come back, I'd like to look a little further into the political aspect of all of this. We'll be right back with more International Focus.
The Institute of World Affairs presents our community with a range of public programs relating to global issues, U.S. foreign policy, and the world economy. For more information about the Institute of World Affairs, call 414-229-3220 or visit our website at www.iwa.uwm.edu.
Welcome back to International Focus. We're talking about the possibility of a Euro meltdown with Abdur Chowdhury and Ken Spirewka. Well, Ken, before our break, you touched on sort of the diverse nature of the nations within the Eurozone and a little bit about the politics involved. Now, particularly in Germany, which seems to be doing much of the heavy lifting in these bailouts, what are some of the political ramifications if I'm running for office in Bavaria right now?
The political ramifications in countries like Germany are pretty high, actually. For Angela Merkel, it's a critical issue. The reason is, as we were talking earlier, that the German voters are saying basically, why should we pay for the Greeks' mistake? And that's a fair question at this point. But I think that this will continue, and I think overall for the countries in the region, I don't see an unraveling of the euro at this point. The reason is the cost of unraveling is extremely high for all the countries involved. The problem is, as Ken mentioned earlier, what we have in Europe is a monetary union, but we do not have a fiscal union, or we do not have a system where
now, what's
we have
the difference between those two?
The difference is basically we have the monetary policy is being determined by the European Central Bank, one uniform policy for all the countries, whereas the fiscal policy is determined at the national level, where we don't have any specific common interest. So national governments are basically following their own interest. And since you don't have a fiscal union, you don't have a political union, so we have this problem that we see. And another,
So, for example, the Greek government can decide to engage in deficit spending, and no one in Brussels can say much about it.
actually, there is some mechanism. They do have a target debt GDP ratio, for example. They have another target that fiscal deficit cannot be more than 3% of GDP. What happened is those targets have been missed by countries a number of times, and all the European Union can do is impose fines on those countries. Greece has been fined a number of times. A number of other countries has been fined. So it's extremely difficult to implement those. And another problem that I see there is basically what I call the north-south divide. You have the northern Europe with countries like Germany who are highly competitive, and then you have countries in the south, Portugal, Greece, example, who are not competitive. And as a result, you see countries like Germany with a huge trade surplus, whereas countries in the southern Europe are running a huge trade deficit. So unless you take care of that imbalance, this type of problem will continue.
Well, and what mechanisms are there to address that imbalance within a unified currency? We've spoken earlier about the impossibility under that scenario of devaluating. So if I'm the leader of one of the less competitive countries, what levers do I have?
Well, in terms of, I don't know that there's any mechanism. There's certainly economic philosophies that can be implemented at that level. As you mentioned, in the U.S., we control our fiscal and monetary policy, so we can make adjustments for our economy. And typically, when you have a country with a surplus of a trade surplus, then their currency strengthens commensurately with that. Conversely, if you don't, then your currency will weaken. Well, in the euro, of course, you don't have that luxury with all these component parts. You have 17 different countries that comprise the EZ, and you have each of them performing at their own rate in terms of GDP growth. So the only true mechanisms would be some sort of monitored and regulated austerity measures, like has been implemented with Greece, much to the chagrin of the population in many respects. Perhaps a lot of it will be derived from just the overall, from the consumer level. When there's uncertainty, consumers tend to save more money, and as a result, you might get an influx of savings, which could have a negative impact for a cash-rich or a net trade surplus country that's doing all the exporting. If they decide to seek higher yields in their cash, they might inadvertently invest in a higher yield bonds in other parts of the EZ. So unfortunately, there's not a panacea that can be implemented to control that 100%, but it's going to take regulation and austerity measures, I think, at the forefront, and then drill down into the more political ends of the monetary policy.
Well, let's talk a little bit about Secretary Geithner's remarks and the impact of all of this on the U.S. economy generally and the U.S. recovery specifically. What is the connection?
As I mentioned earlier, there are two ways what is happening in Europe can affect the U.S. economy. One is through exposure of U.S. banks to the debt crisis. In that case, I don't think the exposure of U.S. banks is too high. So there, I don't see a major problem. The major problem I see is, as I said, this flight to capital coming to U.S. and strengthening our currency. That, I think, will have a greater impact on the U.S. economy. Strengthening of U.S. dollar will basically hurt our net export, which I think will hurt our recovery. So that's where I see the problem.
And Ken, do you see anything in your work day to day as a result of this? I mean, in the behavior of companies?
The thing I see in terms of company behavior is they're not willing to spend money. Now, a lot of the U.S. companies, certainly in the Fortune 500, are loaded with cash on the balance sheet, and I don't, it's not just a direct fear of what's happening over in Europe. We have our own problems, and we still have a long way to go ourselves as a nation. Obviously, we're the economic engine. that drives Europe and most of the world, apart from perhaps China, you can make a strong argument for now. But in terms of how the U.S. companies are perceiving the Greek problem and ultimately the European debt crisis, it doesn't seem to make a big impact on their decision-making process. I think they're going to unlock their balance sheets when they, first of all, when they know how they're going to be taxed, how the Obama health care is going to impact them from a fiscal standpoint. And once those things are sorted out domestically, I think the companies are going to respond to however those decisions fall, the European crisis notwithstanding. Now, where it might impact, obviously, companies, multinational companies that have exposure in Europe, and they're translating euros back into U.S. dollars, are getting hurt. By if they haven't hedged effectively, they're going to be hurt by the lowering value of the euro. Conversely, the strengthening of the U.S. dollar is probably going to help their cause, because our trade imbalance is our net, we're going to get higher because we're going to start importing more products from overseas because of the strength of our dollar. So in effect, could import inflation here, which may or may not be a bad thing. It's been a pretty quiet monster as of late, and interest rates are a direct reflection of that. Especially with the latest maneuver by the Fed with Operation Twist, making short-term rates higher and still trying to lower the lending level of 10-year, 20, 30-year money. So I don't see it really impacting the U.S. all that greatly. I hate to say that we're on an island, because we're not. We certainly have far-reaching exposure to not only Europe but other parts of the world that will be impacted. But will this be like another 2008? No, I certainly don't see that happening. I think it's just part and parcel of the whole amalgamated process that the world's going through to right itself, and this is hopefully the tail end of what we'll see in the next decade.
Well, yeah, I agree that I don't expect this problem in Europe to sort of explode and the whole thing unravel. I hope that the European Union leaders will be able to come to some sort of understanding in late October and also in November, when the G20 has a meeting, and where they will have enough fund to recapitalize the banks in Europe, which may be affected once there is some sort of a default increase, some sort of an orderly default increase. So I don't expect this whole thing in Eurozone to unravel. But
well, it seems like in many of the stories we cover here on International Focus, there's always a China dimension. Is this a story with a China dimension?
Well, I think China's in its own dimension, and to be fair, I think that China's been sort of, it's been a good thing for the world right now, because it's at least something that continues to grow. They seem to have maneuvered a soft landing in China, and it's been a place that in these uncertain times that the investor, the investment community can sort of rely upon. I think they're going to be impacted overall, but I think that they're moving more and more to a reasonable GDP growth. They're not going to be explosive as they have over the past decade. But I think they're starting to maneuver themselves in a pretty good position. They've done some very good things, I think. They hold a lot of our debt. They hold a lot of the world's debt. So they're certainly going to be impacted by what goes on. But I think they've been sort of left out of the picture when we're talking about the European debt crisis and what's going on in the U.S. Certainly the U.S. has got a stronger connection because of the amount of debt they hold. But I don't foresee them being impacted any worse than the United States will be in the event of an unraveling. But I really agree with Dr. Chowdhury here that what we're probably going to see is some version of a triage economic happening in the Eurozone, where there's going to be an orderly default, where the strong help the weak, and they make that work some way, somehow.
Well, we've got it's about a minute left, and I'm wondering, at sort of the takeaway question, given the differences between the Eurozone members and some of the structural diversity, if we get over this current crisis, is it just going to be a cyclical thing and we'll have to be having this conversation again in a few years, or can this be solved?
I think we are going to have this type of conversation down the road, yes. Given the diversity of the countries in the Eurozone, there will be some problem, maybe not a debt problem, but something else that will need to be addressed at some point. Yeah. So this is not the end of the discussion on Euro.
Very good. Well, Dr. Chowdhury, Ken Spirewka, U.S. Bank, Marquette University, thank you very much.
Thank you.
Thank you for having us today.
To our viewers, we'll see you next time on International Focus.
For information about the Institute of World Affairs and its many programs, or to become a member of the Institute, call 414-229-3220 or visit us at our website.